Hello, I'm Chris Pyke, Chief Innovation Officer for GRESB, and we're going to talk about the evolution of the market. Let's start by talking about the drivers for real asset sustainability. Fundamentally, the evolution of real asset sustainability is rooted in economics, and we're going to talk about some of the most important factors shaping the real asset industry globally. Second, what we do with respect to sustainability is rooted in social and environmental priorities. We'll talk about how those are shaping the industry. And finally, our work is increasingly centered around sector specific opportunities and circumstances, and we'll figure those out too. First, the big picture. Global real asset investors are part of the are shaped by the global flow of capital. And we have all been impacted by a higher for longer interest rate environment globally. We've all faced construction and labor cost inflation, and we continue to deal with changing occupier demand and priorities. One of the manifestations and one of the impacts on this year's GRESB benchmark has been a change in global capital flows. Based on data reported by PwC and the Urban Land Institute, we can see that sharp change in capital flows between 2022, 2023, and 2024, where the 2024 being the bulk of the reporting for this year. You can see in some cases, we've seen a 50% reduction from the peak in global capital flows, and this is reflected across multiple geographies. Second, we face a time of political policy uncertainty. Again, looking at data from PwC and ULI, we can see that their analysis indicates that the level of economic policy uncertainty facing the market in the first quarter of 2025 rivaled previous milestones, including the global financial crisis and, in some ways, even the height of the COVID pandemic. One way or the other, this was a moment where decision makers faced profound and, in some ways, unprecedented levels of uncertainty about what action to take to benefit their firms and their stakeholders. Third, we face a moment of international divergence in opinions and experiences. One way to visualize this is this recent study from Global Scan. What you can see here, when asking global sustainability professionals about their view of the moment and their view of potential pushback or, in their words, backlash against sustainability, what they find is that 91% of professionals in North America, obviously dominated by the United States in this context, perceive or have experienced backlash against sustainability. Conversely, less than 40% of their peers in the Asia Pacific region report similar feelings. Our European colleagues are somewhere in the middle. One way or the other, we see a global divergence in the kind of lived experience of sustainability professionals at this moment in time. These trends also are subject to their own reactions. So, for instance, earlier this year, we have seen major asset managers shift their allocations explicitly based on their understanding and their priorities for long term stewardship and sustainability. This has shifted billions of dollars from asset managers that were perceived by asset owners to be less to place a lower priority on those features to those who put a higher priority on sustainability and long-term responsible ownership. At the same time that the market is facing these challenges and shifting headwinds, we also believe that this is a moment of opportunity. And let me highlight three opportunities that are likely to shape the market ahead. One, leaning back on our colleagues at Goldman Sachs, there are bullish perspectives on the real estate market that after a long period of being run down and competitively disadvantaged in the capital markets, there is a sense for, as an example, from Goldman Sachs, this data based on NCREIF, that the market felt its bottom in 2024 and is poised for a relative outperformance against other asset classes in the near future. And so there is a sense that asset values may have hit their minimum, and this is a buying opportunity for real estate and other real assets to outperform other investment opportunities. At the same time, that period of higher for longer with respect to interest rates appears to be, at least in the perception of the market, winding down. If you look at this recent study from CBRE, you can see that across a range of sectors, a significant fraction of market participants believe that cap rates will be heading down over the next 6 months. And so what we're looking at is this evolution toward lower interest rates and a little less pressure on business models. The third is that despite those headwinds, we continue to see significant growth opportunities. One of those is data centers. And obviously many of us are aware that data centers are essentially a hybrid of real estate and infrastructure. One way or the other, this asset class within the real asset category is expected to continue its significant growth to meet the demand for AI workloads as well as fundamental capabilities that we all need for our lives. Every time we're listening to this presentation, or we're saving a photo on our phone, or our car is connecting to the internet, these are all running through these data centers. That creates strong demand fundamentals on a global scale. Let me close by talking a little bit about differentiation and global directions, because this is, in many ways, the challenge of this moment is not some sort of global average. Rather, it is a case where our colleagues in Europe, the Americas, Asia Pacific are at this moment responding to different drivers and in some ways going in modestly different directions around the world. As I told you earlier, there are strong differences in perceptions about market resistance to sustainability, but there are also different priorities. So, starting with Europe, when we talk to our European colleagues as an Amsterdam based organization, we understand that there is a cross cutting concern about reporting burden and concern about changing regulatory requirements. This has been an incredible 12-month period with respect to the European Union's omnibus proposal and changes in direction on fundamental legislation such as CSRD and other factors. And so, one way or the other, this market is concerned about the challenge of reporting and the rules of the road. The second priority in Europe has been a focus on environmental performance, particularly decarbonization and physical risk. In some ways, the conversation about sustainability has gotten narrow. It is focused on downside risks associated with holding carbon on a balance sheet and physical impacts on property. The third one is a priority on asset outcomes. So, relative to other regions, European investors and asset managers have been demanding for granular information on the performance of individual assets, often buildings, shopping centers, or similar. They want to know energy intensity, emissions, they want to understand risk mitigation at a very granular level. And some investors, such as our colleagues at PGGM, have a know their asset policy for their private investments, and they're applying that aggressively. In the Americas, we have a different tone and tenor. It's easy to get caught up in the headlines, but there's a lot of activity under the hood. One, operating costs. The rising price of retail electricity is and a limited top line growth in rents is putting a premium on efficiency and expense control. And this is something that we can deal with within the context of sustainability with our traditional focus on energy efficiency and reductions in things like utility costs for water, waste, and similar things like that. We also see a priority on physical risk and resilience. This is most directly expressed through insurance costs and a concern about getting insurance, keeping insurance, and mitigating rises in insurance rates over time. The third and emerging issue is a greater understanding and appreciation for interaction with the utility grid. It's not just your average annual energy consumption. It's how does the consumption for a piece of real estate or infrastructure impact the grid when the grid needs it most. That issue of the coincidence, the timing, the location of energy demand is emerging to be just as important as average annual consumption. That is going to intensify as renewables continue to come on the grid, including solar, batteries, and other load shifting technologies. Finally, our colleagues in Asia Pacific. This region experiences less investor pressure, but more market competition. There is a desire to show that companies are keeping up with their peers and in some cases striving for market leadership. The region also embraces a more holistic view of sustainability, broader goals applied at larger scales. We're talking about industrial zones, cities, and other kinds of applications. And third, this is a market that values third party credibility. There is more emphasis on third party standards and labels as a source of truth and verification of achievement. There are also specific things this market does differently. For instance, the Asia Pacific market has embraced sustainability linked loans, envisioning a next generation of loan products that address some of the limitations of historic vehicles and provide capital for sustainability action on the ground. Let's bring this back to the bottom line and close this section out. The growth and impact in real assets will look different in the future. We are going to grow together. This growth over the next year, 2 years, 3 years is going to be refocused on business fundamentals. We've never lost sight of the connection between sustainability and real asset value and risk, but we are going to redouble our emphasis on that connection in the months ahead. We also understand that based on what I told you, we will need to respond to these drivers in a regionally differentiated way. That means that our priorities in the Americas will be distinct from our priorities in Europe and Asia Pacific. That's a good thing. We can do that and embrace the regional differences in circumstances, needs, and opportunities. And finally, the road ahead will also be more sector specific. There is not, even though we are rooted in our belief that that a sector specific benchmark specifically for real estate and infrastructure is necessary and valuable. We need to go even deeper. We need to understand that the way that data centers work is different than the way that airports work, is different than the way that offices work, is different than the way that retail works. We want to address, understand, and ultimately recognize those differences so that we can drive positive engagement between investors and their managers. With that, I appreciate your time and I hope you enjoy the rest of the program.